sure that, okay, thank you. Well, good evening, everybody. So for the next 15 minutes or so, I was hoping to run you through the philosophy used to manage the Pacific Assets Trust, the outcomes of the philosophy, both qualitative and quantitative, and then finish on the portfolio with hopefully a lot of time for Q&A. I think you'll all have some appreciation of the opportunity that lies ahead for Asia over the coming decades. And I hope by the end of this session, you'll understand how Stewart Investors approaches investing your capital in this wonderfully dynamic region. Now here I have the foundational investment principles of our philosophy. And this is the same philosophy that Stewart Investors has used to steward our clients' capital since we first started investing in Asia in 1988. And at Stewart Investors, we spend a lot of time trying to understand the people we're handing your money to. So I think it's only fair that we provide an insight into what we believe and how we think and how we act. Now, really, underlying everything that we do is this absolute return mindset. You know, we see risk as the risk of losing your money, not deviation from a benchmark. And this really provides a foundation for everything that we do. You know, if we're aiming to protect and grow your capital, we believe that, you know, a long-term perspective is critical. You know, this industry is plagued by noise and short-termism, and we believe that, you know, we offer no real value in guessing how stock prices are going to move over the short term. But really, by taking a longer-term perspective, and for us, that's thinking about what a business and a stock could do over the next 10 years. We have the ability to play a different game than many others. And over this time period, much of the noise fades away, and investment cases can coalesce around enduring points like the people running a business, the robustness of a balance sheet, and longer term growth tailwinds. And for bottom up, we're really talking about the ability to ignore the index and build a portfolio with a blank sheet of paper. And for us, position sizes in the portfolio are a reflection of our conviction in the company and our view of potential returns, you know, rather than plus or minus versus a benchmark weight. And when I talk about outcomes in a few minutes, you'll see that our portfolio really looks and behaves very different to the Asian benchmark and our peers. Finally, sustainability and quality. For us, these are just two very natural outcomes that comes from taking a long-term approach to investing your capital. We have been incorporating a sustainability lens into our analysis for over 20 years. You know, this is long before ESG or the Sustainable Development Goals were a thing. And it's really coming back to that point, that foundational point on absolute return mindset. You know, we're using sustainability to further understand risk and reward. We want to understand how long-term headwinds and tailwinds from changes in consumer preference or government regulations are going to impact cash flows and therefore share prices. You know, we want to understand longer-term risks to the income statement or balance sheet from operational fragility from climate change or a very simple inability to hire and retain high-quality talent. You know, we think about these questions because we believe it's a driver of returns rather than detractor. You know, we want to be the best long-term investors and stewards of clients' capital in Asia. We strongly believe that incorporating sustainability in this way is a key factor in us achieving that goal. You know, finally, quality. You know, there is no long-term capital protection and growth over the long term unless you have the ability to earn and protect and grow cash flows over time. You know, we look at quality through three lenses: quality of people, quality of franchise, and quality of financials. You know, I think most managers are going to sit here and say they think about quality. You know, but probably what sets us apart is the emphasis we place on the quality of people we're handing your money to. You know, it forms a major part of our analysis, a major part of our debate. You know, as we attempt to answer, you know, critical questions like, do we trust the people with your capital? Are they aligned with our time horizon and our outcomes? And are they competent? You know, these are simple questions, but you can't answer these with a spreadsheet or a decimal place. You know, you need a small team of passionate analysts who really love getting into the weeds on qualitative factors, and you know, that's something that we very much have here at Stewart Investors. Oh, sorry. Sorry. Here you have it, a quick set of outcomes of our philosophy. You know, we put these up because we want our clients to be able to hold our feet to the fire, you know, ensuring we're sticking to our philosophy. You know, we can't control performance over the short term, but we believe that these outcomes provide important evidence that we continue to walk the talk on our philosophy. And again, in an industry where there's lots of talking and perhaps not much walking, I think it's an important part of our service to clients. So you can see here, high active share. We have a portfolio that looks and behaves very differently to the index. Outperformance in down markets and low downside capture. Due to our focus on high quality companies with resilient balance sheets and cash flows, our companies tend to outperform when there's a lot of fear in the air. And I think it's important to note we are not actively sitting here trying to forecast down markets. We're looking to build a portfolio that can survive and prosper in most macroeconomic environments. The point on long-term time horizon, hopefully again these figures reflect the long-term approach to allocating your capital. There will be moments in time when turnover spikes, like in COVID when we were given a wonderful opportunity to buy companies on very cheap valuations. But broadly, we would look for turnover to reflect an approach that is aiming to benefit from growth in underlying business value rather than jumping in and out of names on share price volatility. And finally, quality and sustainability. This is a select but not exhaustive collection of outcomes. Stewards, I'll touch on this more in the next slide, but by stewards, we mean a long-term economic owner behind the business we're investing your money with. And for us, that's vitally important to long-term value creation. Holdings with net cash, the majority of our companies have more cash than debt. And this is a function of the cash flow capabilities of our companies, as well as the people at the top of these businesses who have long memories and deep scars from previous cycles, and appreciate that for long-term success, you first must survive the inevitable, unpredictable crisis that come along. Finally, carbon footprint is one very simple way we use to assess the sustainability of our companies. But more broadly, we're looking to own companies that are contributing to human development and/or a reduction in environmental footprint. We have what's called a portfolio explorer on our website, where you have the ability to see every company that we own and a rationale for why we believe it's well positioned over the next 10 years. So, it'd be great if you could go and please check that out. That's been I think an important part for us of being able to express and articulate how we think about quality and sustainability in a world where probably sustainability is the least sustainable word out there. So yeah, please go and check out that portfolio explorer. So who are we handing your money to? Here I've chosen to split the portfolio not by sector or country, but the classification of the owner of our businesses. I think they're mostly self-explanatory. Free float here simply meaning that there's no identifiable economic owner. And here you can see that most of the companies held in the trusts have a family behind them. And I know that the initial reaction is, hey, wait a second, we all know that families tend to be basket cases. Siblings fall out and the outcomes are never good for minority shareholders. We've all watched Succession. Now, I'm not saying that doesn't happen, but we're looking for long-term owners because we really appreciate and get excited about being able to take the trust hard-earned capital and invest it alongside people that can take a long-term perspective and ignore that short-term noise and are building a business that will be a bit higher quality in 10 years, rather than the next 10 months. I'd even go as far as saying that, this is a superpower that rarely gets, enough time in the investment industry. We aren't simply looking to hand your capital to any run-of-the-mill family. We're looking for high-performing family-owned companies that have both the time horizon and the competence to build something special. We do reject the vast majority of families that we come across. In Asia, this ranges from Bond villain type characters, to the typical family that sees the company as a piggy bank for them to do as they please. Where there's not an identifiable owner, we spend a lot of time trying to understand a company's culture. There are the rare companies who, without an identifiable owner, have the ability to create a culture with a sense of ownership and a long-term time horizon. And that's where you will tend to find the Pacific Assets Trust being invested. On the right-hand side, you'll see that the trust doesn't have anything invested in state-owned enterprises. As investors who care so deeply about who we're handing your capital to, it tends to be a relatively simple answer for us when it comes to investing in SOEs, because very often, if not always, when there's a decision to be made, the state-owned companies will favour the best interests of the state over us as minority shareholders. So it's a relatively simple decision for us. Forming a view on the quality of people is heavily qualitative. For us, financial history plays a key role here. When we want to see evidence of behaviour in the good times and the bad, and believe that trust is largely a function of consistency and time. We don't want to be worried about being stolen from when a founder's back's against us, against the wall. We generally, lepers don't tend to change their spots when it comes to how families and management teams see their role in regards to a company's fortunes. We also spend time trying to understand how a company deals with its many stakeholders. We often find that when there's evidence of poor practice with one stakeholder, very likely there's to be more skeletons in the closet. Traveling to meet companies is a vital part of our research. Getting boots on the ground in the region, talking to families about their succession plans, whether there's a family constitution, talking to managers about how they allocate capital, how they believe their employees should be remunerated, talking to employees about their loyalty to the companies, whether they believe that the values or the behaviours of the management team are true to what we've been told. And really, this is one of the most enjoyable and powerful parts of our job. Building relationships with companies and third parties across Asia is crucial to us, very simply because we can't rely on investment banks to give us what we need. If I was to read a 100-page research report on a company, you'd be lucky if there was even one paragraph on the people behind the business. So it's important for us, to supplement that research, and that's largely dependent on us traveling and really building a collection of trusted third parties that allow us to build up a picture of people across the region. Now, this is a bit of research from others out there. But you can see, for us, allocating your capital to companies on the right-hand side, to companies with corporate executives that hang around for less than 5 years, with the potential to make tens, if not hundreds of millions of dollars, is a very risky proposition for us, because it's very easy to understand the types of decisions that they will be making. They will be looking to maximize the value of their business over the short term rather than over the long term. And we're really looking for companies that have that superpower and that ability to think and act for the long term. Here I have the performance of the philosophy over varying time horizons, ranging from 1 month at the bottom to the 10-year periods at the top. And as mentioned, we have a team, a culture, and a philosophy that's focused on the top part of this chart. We want to be able to deliver attractive returns to long-term holders of the trust, and all philosophies must have trade-offs, and we're often reminded, if you don't stand for something, you fall for everything. So for us, we're willing to forgo trying to outperform every short-term period and every short-term game in order to build that portfolio capable of delivering long-term outcomes. Very quickly, this is just another way of expressing historical returns, with anything above the line being outperformance and anything below the line being underperformance. You can see that on the left-hand side, the trust really has tended to protect your capital far better in down markets, which has been an important foundational point to the long-term compounding of capital. And on the right-hand side, when markets tend to be a little bit more frothy, a little bit more aggressive in their view and less regard for valuations, we tend to underperform those markets, but importantly, have been able to deliver, in my view anyway, attractive absolute returns. And I think really this chart really shows that if you are looking to time getting in and out of Asian markets, that the Pacific Assets Trust is probably not the right trust for you. I think it's far better suited. Our philosophy is far better suited to somebody that's making a longer term allocation to the region. So finally, what does the trust look like today? India, as it has done for the last 10 years or so, really represents the bulk of the trust's assets. It's very simply the country where we find the best opportunity to hand your capital to high quality people managing great businesses with strong long-term tailwinds. India has, I think, one of the most diverse equity markets, which for us as passionate bottom-up stock pickers is really a wonderful place to invest, and it really gives the trust a broad exposure to some wonderful tailwinds. Unlike other emerging markets where you're forced to perhaps invest in a bank or a telecom company, India really is a diverse stock market, and the trust really has exposure to, like I mentioned, a broad range of sectors and tailwinds, ranging from growing financial penetration to technological advancement in agriculture, and more recently, the rise of India as a global manufacturing hub. Importantly, today, I think India's large consumption-driven economy provides a pretty enticing opportunity for companies to compound away, largely insulated from the growing geopolitical tensions that are appearing on a minute-by-minute basis. China has been a relatively small part of the trust, and this, as you will understand, given what I've said for the last 15 minutes, is really a function of our inability bottom up to find great opportunities to hand your capital over to great companies. And this is either due to questions we've had over a company's alignment with the Chinese Communist Party, or a company's alignment with us as minority shareholders, or very simply where we find great companies with the alignment that we're looking for, just valuations of our type of company being too high to make, in our view, attractive returns. Now, this investment in China has been going up over time as we work our way through the investable universe, and valuations have become more palatable. Companies in the trust are leading players in the automation, robotic, software and medical sectors, and many of them are very well positioned to benefit from the Chinese Communist Party's desire to reduce China's dependence on global multinationals in key sectors, as well as the pressing need to build a high quality, low cost healthcare system. Now, over the short term, our weights in China, India have hurt performance. With the with the Chinese market up over 40% over the last 6 months, and India being down roughly 15%. Now, we did trim some of our more expensive Indian names, but obviously we didn't trim enough. I think you can hopefully see here again a reflection of our philosophy in action, that in our view, attractive long-term compounding of capital with that protection of capital in down markets. But really looking forward as a long-term allocator in Asia, we're always incredibly enthusiastic about the opportunities for long-term capital growth. Now today, given the valuations that are open to us in India, China, and Southeast Asia, we're really spoiled for choice in terms of where to invest the trust capital, and historically that's been a wonderful precursor to very attractive absolute returns. And really the valuations that we're being asked to pay for the potential growth profile, I think many US investors have probably thought these opportunities were resigned to history. I'll stop there, and hopefully during the Q&A we can touch more on the portfolio outcomes. But like I said, hopefully this has served as a useful introduction or a helpful reminder of how we seek to invest your capital at the Pacific Assets Trust.
Lovely, Douglas. Thank you very much indeed. Okay, let's get straight in with the questions. The first one, very simple. Do you pay a dividend, and if so, what is it?
We do pay a dividend. I can't give you the specifics at the moment, but there is a dividend that's paid. Largely, the focus of the trust is long-term capital growth over yield. So I think if you were to compare us against our peers, it would be lower than our peers. But like I said, that's largely a function of us looking for long-term capital growth.
Okay, next question is about valuations and India. Are you comfortable with valuations in India? Do you think it's an expensive market?
So I certainly think that India always falls foul of being, compared directly to China. I think the investable universe in both markets are not apples to apples. In China you have the index being dominated by large state-owned financial enterprises and commodity companies, the internet companies, whereas in India you've got a greater breadth of really high quality companies towards the top part of that index. So I don't think comparing apples to apples is right. For us, valuations is really a function of what we believe we can earn over the next 10 years, rather than simply closing our eyes and believing that price to earnings ratio will deliver a particular return. So I think India last year had benefited significantly from particular enthusiasm in parts of the market, especially in the small mid-cap space. We were really looking at some of our favorite companies being valued at close to 100 times, and we were reluctant to allocate the trust capital there. Post that time, I think you've seen India experience a sell-off similar to what it experienced during the GFC. So that's brought valuations back to a far more reasonable point, and coming back to the opportunity set within India, that for us, we're looking at what a business could earn us over the next 10 years. And you have, first of all, wonderful managers at the top of these businesses that understand cost of capital and therefore look to generate very attractive returns, and are operating in markets and sectors where there's significant and growing profit pools for them to grow into. So I think if you're to compare the Indian companies versus Chinese companies, I think they would continue to be on a higher valuation. But in regard to the opportunity set for potential returns, I think they're far more comparable today than they were, say, perhaps 12 or 18 months ago.
Okay. Question says, there's no current gearing and little in the recent past. What is the reason for this?
So it's a constant conversation that we have as an investment team and with the board. And it really is a function of the investment outcomes that we're looking to deliver to our, the holders of the trust. As I mentioned, the trust long-term performance has really been built on the protection of capital in down markets, in providing the opportunity for long-term capital appreciation. And obviously, by adding gearing, it exacerbates the downside volatility of the trust. And historically, that's just been something that we've been reluctant to do. But I would say today, coming back to that point on the opportunities that we're presented with across the Asian region, that this is probably the first time in a long time that we're having very serious considerations about, or conversations about, whether we should take on some gearing.
Okay, next question. I'm not sure if we'll be able to answer, but it came in. So the question is asked, I hold Stewart Investors APAC Sustainable Leaders Fund.
Yep.
Is this trust distinctly different?
Yeah, thank you. So it's managed by the same team with the same philosophy. The major differences between the trust and Asia Pacific Leaders is largely down to market capitalization. Asia Leaders, we own companies with a minimum free float of $1.5 billion. And given the closed-ended nature of Pacific assets, we really get excited about utilizing the lack of liquidity requirements, and you'll see Pacific assets having a far greater exposure to smaller cap names than in the Asia Leaders. And I think over time you would hopefully see the same outcomes, but over the shorter time perspective, the general outperformance, underperformance of small cap versus large cap, I think will largely drive any performance differential.
Okay, one final one. Question about Vietnam. Wasn't in the top 5. Do you have holdings in Vietnam?
We don't, unfortunately, have holdings in Vietnam. There's a couple of wonderful companies that we should have owned, but we were too tight on valuations. So it's definitely been a mistake. But I can say that there's a couple of names that we spend a lot of time looking at, and the intention is over the course of the next 6 months to get back out to Vietnam as part of our trip to Southeast Asia, and really understand the opportunity there. But like I said, it's only been a mistake to not own these companies.
Well, thank you very much for joining us this evening. Really appreciate it. Thank you.
Thank you very much for your time. Thank you, everybody.